Choosing the wrong mortgage could cost you tens of thousands of dollars and lead to you potentially losing your home. You don't want to choose wrong. Now, there's three main possibilities that I see likely with interest rates. One is that interest rates stay relatively flat and they're consistent. So we see things not change a whole lot. The second scenario I see is that rates are going to rise a little bit more, but then they drop off. And I think it's a little bit optimistic to hope for, but I think it's possible. And the last scenario is that we're going to see rates rise and continue to trend upwards, and we don't know when they'll hit the peak. So the first thing you really need to do when you're choosing the right mortgage product is to explore those three scenarios and one, come to the conclusion of what you think is the most likely, whether it's talking to professionals, doing your own research, or just making your own decision. It really is a guess, and you're going to have to decide which route you're going to guess, because I don't know. I don't think the government knows. The news certainly doesn't know. And well, the banks are all saying different things, but they're not agreeing on anything, so they certainly don't know. But once you've narrowed down which you think is most likely, I think you should look at each of the scenarios and see how they'll impact you. So the thing I really suggest for Canadians and homeowners to do is to do a personal budget. And I know it's not sexy. I know it's the last thing you want to do. But understanding how much income you have that goes towards your day-to-day life, your kids, schooling, gas, whatever you need to spend, and understanding how much is left over that you can put towards a mortgage at the end of the day. That's going to let you work out, and I can help you with this if you need, at what interest rate can you no longer afford the home you're looking at or the home you own. When you understand what that number is, it's a lot easier to make decisions for which choices should you make. If you're right on the brink of not being able to afford your mortgage payment, then you have to figure out, can you afford what your lock-in option is? But if it's a comfortable number, then you seriously want to be considering it. Whereas if you can handle the interest rates to 10, 11, 12%, you can kind of ease up a little bit. It becomes less of a decision of at what interest rate do I lose my home, and more of a gamble or a bet on what's going to cost you less money. And another thing I really, really believe you should consider is what's going to cause you less stress. When I finally decided to lock in my mortgage, it was more for peace of mind and stability and to just not stress about it. I accepted that if things cost me a little bit extra, that's okay. I just didn't want to be constantly thinking about mortgages consistently and really worrying about, rates and what's going to happen. And I'm a broker. I do this every day. So I think the stress thing is really something that people should consider. But once you've narrowed down what you think will happen with interest rates, or at least what the possibilities are, and you've looked at how they'll impact you, there's three real options you're going to have available. One is a floating rate mortgage, two is a short fixed term mortgage, and third is a mid or longer term fixed term mortgage. So let's just take a quick dive into what each of those options are. The floating rate one's pretty simple. We all know them. They're typically called variable or adjustable rate mortgages. Now, at the end of the day, a variable or adjustable rate mortgage is going to have the highest degree of flexibility. So if you decide to break the mortgage, the penalty is going to be 3 months interest, which is typically 3 to 6 times smaller than a fixed rate penalty mortgage. All the math gets funky and depends on what happens with interest rates, but the important thing to know is that variable or adjustable rate is typically more flexible. The trade-off is that we don't know what the interest cost will be. So if interest rates drop, yay, we win. We made the right bet. Adjustable rate was the way to go. But we're trading that potential win and some flexibility for the risk that if interest rates rise and continue to rise, we're going to be a bit of a passenger, a bystander. And we need to make sure that if we take that gamble, that we can afford to lose. So that's why I lean back to doing the personal budget. Now, it is important to know that there's two types of floating rate products. There's an adjustable rate mortgage where your payments will rise or fall as interest rates change. And there's something called a variable rate mortgage. A variable rate mortgage, think of it like a fixed payment variable. Your interest costs will rise and fall with prime, but your payment will stay the same. The drawback to that is some people are learning right now where they locked in or they took their variable rate mortgage when rates were super low, is that now their payments do not cover all the interest they owe. and they've crossed something called a trigger rate. Trigger rate is where you hit the point where the interest rates rise enough that your payments do not cover all of the interest you owe every month. So the balance is rising month over month. Eventually, they will hit something called a trigger point. Now, this is different for every lender, but typically speaking, a trigger point is when the amount you owe exceeds your original mortgage amount, typically 80%, or it exceeds 80% of market value at the time the lender looks at things. So just tuck it away, send me a message. If you're in a variable rate and you want to know more, comment your questions. I'll do another video on this. But at the end of the day, variable rate and adjustable rate are a gamble that rates will drop in the relative near future and have the benefit of being more flexible. And you also have the option to convert it into a fixed term of equal or greater length typically. So what that means is that if you take a variable rate or an adjustable rate mortgage, you can lock it in. Now, the important thing to know is that that means you're going to convert or lock into a, let's say, a 5-year fixed rate. You don't get to keep the variable rate or adjustable rate you have, but rather you get a new rate. It might be 6% today. The bank has the benefit of being able to give you this without you paying a penalty, but they also know that you're trapped. So often they will offer you slightly higher rates, and it's really important that you have a good relationship with your lender. And there are certain things you can do to get a better offer. So shoot me a message or leave a comment and I'll share those tips with you if you need anything. But the next option you're going to have is a short-term fixed rate. Typically, it's a 1 to 3 year fixed rate. And those are a gamble that interest rates are going to rise a little bit more, but the expectation that they will fall back down in the next 1 to 3 years. The benefit of these products is that they're cheaper than 4 and 5 year fixed rates. They have smaller penalties than 4 and 5 year fixed rates. And they give you a stability to your interest cost and your payment. The drawback is that it's kind of like jumping from one spot to another. Unlike the variable, you could choose to lock in at any point if you're getting uncomfortable. With a 1 to 3 year fixed product, you have 1 to 3 fixed years until your renewal date comes up, and the only way to change that is to either break the mortgage or hopefully be with a lender that does something called a blend and extend. A blend and extend is where they'll requalify you and they can essentially mash your mortgage with a new one, but typically it means that your interest rate's going to go up and they push your renewal date out. The drawback to these shorter fixed term products is that what if you take a 2 year fixed term and in 2 years, interest rates are 7%? You might find yourself renewing with very little control in an even higher cost environment. The last option is a 4 or 5, there's even 7 and 10 year fixed products. Now, the benefit to these products is they provide a relatively long period of stability where you know your interest cost and you know what your payments will be. The drawbacks are that your penalties are significantly higher. So if you sell or break the mortgage, and the most common scenario where you'd want to break the mortgage is interest rates drop. You lock in at 5.8% today, interest rates drop, your neighbor gets 4, you want to break the mortgage. The problem is that lenders are crafty and they've set up the penalties on these products, they're called IRD or interest rate differential penalties, that if interest rates drop, the penalties get larger. So it's really important that if you go into one of these longer term products, you know that you have the stability and that you can afford to keep your property. The biggest mistake you can make if you lock in is locking into a situation that you can't sustain. Because the last thing you want to do is be in a position where you have to sell your home and you've just added a $60,000 penalty on top. These longer fixed term products also provide a little bit of a disadvantage in the sense that rates may drop for a period of time in a couple of years and then continue to rise longer term. And you don't get a lot of control there. Personally, I think that the fixed rate options are good for people that want long-term stability and know that they're not going anywhere. They're also good for investment properties you want to keep long-term because even though the interest cost is higher, it's tax deductible typically on an investment property. But if you're considering locking in, renewing your mortgage, refinancing, or buying a home, make sure you consider all 3 options. And many brokers and lenders will not offer the shorter fixed term options because they don't pay as much. So make sure that whoever you're working with is giving you kind of a holistic view and looking at what's best for you. And it's also important that you take the time to understand what your needs really are and what your stability is. The one thing to remember is that interest rates are rising right now, but if interest rates continue to rise, likely the next thing we're going to see is a recession. So make sure that you really are thinking things over long term and you have someone in your corner that you can trust and really debate and challenge these ideas with. It's not just you should take a fixed rate or you should take a variable rate. Neither choice is right or wrong from a broad perspective. And the reality is, no one knows what the right bet is. Maybe 30, 60 days out, people can guess what's going to happen with interest rates, but longer than that, it is a complete guess. And it's important that you make the bet, which choosing a 2-year fixed, a variable, or a 5-year fixed, any of those options, you're going to have to choose which option fits best for you. You're going to have to make a bet and live with it. And it sucks, it's scary, but if there's anything I can do to help with that decision, let me know.